Today we have with us Michael Lints, who is a partner at Golden Gate Ventures, a venture capital firm based in Singapore. Before I butcher his introduction, I'm going to pass the microphone over to Michael to give a quick intro into who you are, what you do, and then I'll get into the topic of what we're discussing today.
So, hey everyone, my name is Michael. I am based out of Singapore, so I've been there for about 10 years. I'm Dutch, born and raised, so spent most of my life in and around Rotterdam. I'm a techie, like most of you guys, so I studied engineering, had my first engineering job at ING Bank, then started my own startup, which was a data center. Our company was acquired in 2007 by a larger data center and spent most of my life investing ever since. I had a very short political stint, so I worked for the Dutch government as the vice chairman for the Economic Development Board. Did that for about 4 years. The one thing I learned in life is I don't like politics whatsoever. So yeah, and I've been investing for about 15 years now. Most of it with Golden Gate Ventures in Singapore. I focus most of my time on fundraising, both for our funds, but also for our portfolio companies. And then besides doing the VC thing, I've also co-produced a documentary that talks about racial equality in the venture capital industry that won a few awards. And I love sports. I'm crazy about sports. Running, cycling, Formula One, football, basketball, NFL, you name it. Sports is everything.
If you don't find Michael in a co-working space, you will find him at a sporting event somewhere. And he's being very modest. The documentary he produced has won more than a few awards. It has won many, many awards. So one of the reasons that we brought Michael out to Abu Dhabi today is because as part of his job investing with his firm Golden Gate, they've been doing a lot more work in the MENA region. And we wanted to focus our talk today on how to successfully scale a startup. Because let's face it, most people either scale prematurely or when they scale, they have no idea what they're doing or why, right? So let's start there. Let's start at the very beginning. Also, hi, for those of you that don't know, I'm Lalita. I'm the program lead for the Hub 71 program. So if you want to find out more, please talk to me after. All right, so we come back to this. Let's talk about scaling. Let's start with what is scaling? Why do startups, why should they even be thinking about it as a step in their founder journey?
Yeah, and I'm going to start with like a very funny anecdote. So we invested.
The more funny, the better.
Yeah, I have a lot of anecdotes. So I've just had the pleasure to work with a lot of founders over the past 10, 15 years, and we invested in a company, and I won't mention the names, but it's a funny story. So this founder said, I am going to build a business-to-business marketplace for large industrial appliances. And we were like, okay, it's kind of the Alibaba for industrial appliances in Indonesia. Okay, now he knows who I'm talking about, but still. And as he's building the company, we got more enthusiastic. So we put more money to work. And at some point in life, the founder said, actually, this is just fine. The company is doing okay. I'm churning out a decent revenue. I'm just profitable. And that's it. And the VCs were like, well, this is not how this works. Actually, we want you to grow way faster. We want you to grow way more. And we want you to grow the company way bigger. And the founder was like, nope, this is just fine. I'm having a very nice life. And he built an amazing company. You can't fault him. So when you talk about scaling, and when you talk about it from a VC perspective, we kind of look for that 100x or like 1,000x return, right, ideally.
That is what founders fear. They go into the meeting and they're like, we're going to grow at 10x, 100x in 2 years, don't worry.
Yeah, so exactly. So what happens is when we go into an investment, our expectation is that your company becomes, a $500 million or a $1 billion company. But that's not for every single founder, and that is we keep forgetting this. That is just fine. It's all about kind of managing expectations. But for us, scaling means we have a bit of a category within our fund. So we have what we call kind of a home run. That's more than 50x in terms of return. We have what's called a base hit. It's good. It's not amazing, but it's still good. And then you have the other ones that don't do amazingly well. if you look at our industry, only like a few funds globally actually are able to outperform and find those companies that are actually scaling. So our focus is, finding these founders that are able to scale their business, 10, 50, 100, or 1,000x.
And even within that sentence, there's so many things that we can unpack, right? Like there's the part about VCs and thinking about when you're fundraising as a pre-seed, seed, they ask you like where you're going, what you're doing. And even this morning, one of the founders in our workshop was asking, when they come to you and they're like, okay, what's your exit plan? In your initial reaction was like, just don't answer, right?
Yeah, it's like VCs and founders have this really weird dynamic. I've luckily been on both sides of the table. By the way, our company, when I was a founder, we never raised VC money. We decided that the business could actually become profitable fairly fast, and we wanted to grow the business at our own pace without having the pressure of someone backing us and yelling at us. Okay, I don't yell at founders, but yelling at us all the time and asking, how's the business doing, and asking for updates. But so there's this weird dynamic between founders and VCs, and it's really kind of around finding the right partner early on, and that's kind of it's similar to marriage, right? So you kind of go into this sort of dating phase, and then you flirt first, and then you start dating, and then you kind of like each other, and then it comes to a term sheet, and then you sign. But what I've learned over the years is once you get it right at the pre-seed seed stage, it can be like an amazing journey. We have investments that we invested in 2011, 2012, and we're still on their cap table. Even like 12, 10, 11 years later, we're still on the cap table. And the reason is that we might have sold off a small portion of our investment. We still believe in this founder's journey and where they're scaling towards. So I always tell founders, when you start fundraising early on, pre-seed or seed, if you can, take your time and think of who you're bringing on board. I have seen the most horrific relationships between founders and investors just because the fundraising happened too fast and it's not a great match. And the founder has different expectations. A friend of mine, and I can tell this because I told him I'm going to tell this, he runs a very successful real estate fund in the Philippines. He's a very active angel investor as well. So one of his first investments, he asked the founder for 60% ownership. And the founder said, I need the capital to run my business. So the founder said yes.
Oh my God.
Yeah. The business was doing okay. He was going to raise his Series A. And we looked at the cap table and said, we can't invest in this company. And the founder asked why. I said, you're not incentivized to run this business. You hardly own anything. So let's say we invest at Series A, right? That's not a 25% dilution. Then there's going to be Series B, another 20% dilution, and so on and so on. So at some point, this founder would have 0.001 of the company, no motivation whatsoever. So I told the investor, I said, dude, if you want to invest in startups early stage, you can't do this. Like if you look at the pre-seed seed round, ask for 15, 20%, and make sure that the founder has enough incentive to run the business moving forward. We've had angels and seed investors that said, after 12 months, true story, where is my money? So the founder is building their business, and the investor is asking, where is my money? So what we tend to do is when we help founders fundraise within our portfolio, is that before you go out, manage expectations. And just sit down with the investor. I always tell founders, the investors are doing due diligence on you. You do due diligence on the investors. And just ask them, so what have you invested in before? How many failed investments do you have? What do you do if this company is going to shit? Like seriously, what are you going to do? Are you going to call me every single day? You're going to threaten me? You're going to want your money back? Having these conversations is really helpful in finding the right investors fairly early on.
I mean, similar to any job interview, right? A good job interview, you are interviewing both ways. You're making sure you're doing your due diligence. And as much as there's, I guess, a big power dynamic because investors are coming in, they have the money. How would you advise founders to approach this due diligence? as they're doing it? And within that question, how do you advise them on when they should be thinking about scaling?
Yeah, there's indeed this power dynamic, and I always try to I try to demystify venture capital. I'll give one. I told it earlier this week when I was in Muscat. Like, we wouldn't be here. I could not do my job without founders, and sometimes investors tend to forget that that's the real case. If
You won't have a job if there are no startups.
If there are no startups, I don't have a job. That's how simple it is. And I have a boss as well. Like, there's like big firms that give us a lot of money to invest in you guys and hopefully kind of generate a success. So there is a bit of a power dynamic, but I think the way to approach fundraising is literally you're investing in the next big thing. And your capital is adding value to my business, but I'm adding value as a founder to your portfolio as well. If you go to a reception with a lot of VCs, they always talk about the most amazing portfolio companies that they've invested in. Again, so it's always around the moment as a founder that you are fundraising, you should approach investors as your equal and not so much like I'm asking for money, is you are adding to my business, but I'm also adding to your portfolio.
I'm giving you the opportunity.
That's true. That's true. I'll give one example. So we invested in a payments business in Singapore in 2012. And there were only 3 investors. It was us, a family office, and another VC fund. And the company was like really slow growth. So the first 5 years, the company did like literally like this. And then year 7, it did this like a little bit. And year 8, it fully took off. And everyone was telling us, oh man, how did you find this company? And it was like, we didn't find the company found us. And in the conversation with the founder said, I'm just going to build this really amazing business. I just need your help in the beginning to kind of kick things off. I'll take care of the rest. And they did. So the founder wasn't asking for money. He literally said, I need this capital to get the company to a certain scale. Now, I want to talk about how the company scaled, because then we're going to talk about scalability as well. So this company is, I can mention the name. It's a company called CodaPay. They're actually here in Abu Dhabi and Dubai as well, and they're in Saudi as well. They're a Singapore company. So if you are playing a game and you want to buy a new weapon or like a skin, or you want to level up and you want to pay in your game, this company allows you to do so using your cell phone minutes, your bank account, your credit card, whichever way you want to pay. So they do microtransactions for gaming publishers. 12 years ago, not a sexy business. It's small margins, it's small tickets. How do you want to scale this business? So this founder said, but guys, listen, how many people globally play games? I said, yeah, that's too easy. That's like too easy to kind of say, okay, I'm going to capture the entire market. But here's what they said. Said, give us a few years. Let us kind of see that the thesis works. And if it works, scale will come on its own. I was still a little bit iffy on those first few years, but then the following happened. So they said, we're going to use your cell phone minutes first. So you pay in a game, you deduct your cell phone minutes, and that's your form of payment. Early on, they already envisioned, we're going to start with cell phone minutes, then with credit cards, then with bank accounts, then you can top up using cash. And all of a sudden, we saw how big this market was going to be. They started in Singapore, went to Indonesia. So they went to all the markets where gaming is huge. So if you look at mobile gaming, Indonesia was one of the biggest markets. Then they went to the Philippines, and they slowly expanded. And then something funny happened. UnionPay out of China said, hey, this little API that you guys have built for gaming publishers, we want access to this market. Because the one thing they understood was, because it's a low margin, small ticket size business, no one went in. Everyone wanted to be this massive payment gateways for big ticket items. They said, we will be the only ones that will go in on small ticket items. And they took a massive bet. Fast forward to now, I think they're in 78 countries. They're massive in Saudi, they're massive in the US, they've expanded to Europe. Their last round is public. The last round was done at $2.5 billion valuation. And this is of a company that only does gaming publishing. They had two, I would say, good fortunes. One was COVID. During COVID, we all sat home. We were playing games.
Yes.
So that was a big one for them. And then the second one was when Apple and Fortnite had an issue on in-game payments. So all of a sudden, the big game publishers were looking for alternatives as well. So it's very interesting to see how the conviction of two founders, Neil and Paul, went into building a billion-dollar business on something that seems very, very, like almost dismissive because it's such a small ticket item, but they were able to build a billion-dollar business out of it.
So there's lots of tips and tricks and best practices that we can talk about scaling, when to know and all that. But touching on these two founders that you've just spoken about, let's maybe dive a little bit into the founder mindset when we're thinking about scaling. Like how would you advise your portfolio companies when they're thinking about their next step, right? How do you know they're ready?
Part of it is conviction.
Yeah.
So there's scaling too early and there's scaling too late. I think scaling too early is you want to get the company to a certain size where you have the flexibility to go into a new market or to go into a new product or a new feature. What we've seen typically is, and this is within the Southeast Asia context, where you operate a company within different countries. So you typically start within one country, right? So you start within Singapore context or Vietnam. And then you want to at least become the number, let's say a top 5 player in terms of market share before you go into a new market. There's a number of reasons for it. The moment you enter a new market in a diverse region as Asia, it effectively means that you're building a new company altogether because it's a different language, it's a different culture, it's different regulation. So you're almost building a new company. So you have to be at a certain size of company to kind of move into a next market.
Because you're essentially finding product market fit in another market.
Exactly. And people often think like, okay, I have a product that works in one market, I'm just going to bring it to another market and it's going to work as well. It's not the case.
Every country is a different jigsaw, you guys.
It literally is, and there's one payments company out of the US. They expanded to Southeast Asia in 2017, and the first thing we said was, please stay in Singapore and Hong Kong first before you go anywhere else. And the reason was because Singapore and Hong Kong are markets where credit cards are very, very normal. Indonesia, different ballgame. Philippines, different. Vietnam, different as well. So they only went into mature markets within the Asia context. So we typically only want to scale when you get to like a certain market size within your home market before you go into your second market, unless there is definitely different ways of looking at it. We invested in a fintech company out of Hong Kong. They were regional from day one. So they built an open banking API. For them, it didn't make sense to be country specific. They wanted to be region specific from day one. We've done a company in HR SaaS. They were global from day one. So it also depends on the type of business that you're running.
Or how you're looking at your market to begin with. How would you recover if you prematurely scale? Can you?
Definitely yes. We've had a number of our investments that went into a lot of markets way too early, and then we decided to scale back. Those are the tougher decisions because what happens is, in one case we had one company, it's a fintech business, went into 6 different markets almost at the same time. We've decided to scale back to 2 main markets, and we just did the math and said, the money that you're spending on marketing, getting into these markets is way too expensive. You should actually use that money to grow into your home market. So we always do this a bit of a metrics exercise in how big are certain markets and what is our market position there. So we look at market sizing, we look at our competitors, we look at how fast are we going in this market. Of course, look at our market share. And then we try to evaluate how much growth we've seen in these new markets versus our home market. And then sometimes it makes sense to say no to a market and then just focus on your home market first, get the skill there, and then sometimes say, you know what, this kind of works for us as a business. We don't have to expand to new markets. We're just going to expand in our home market. And in some points, you can sort of learn from your lessons that you've had previously, and then sort of go back out into these markets again.
Yeah, fair enough. I want to take it back to earlier. We were talking about VCs, right? So we're scaling. We've understood, we've got some good home base. We've got good traction. We're ready to move on to the next market. One of the key things you said earlier this morning was as you are fundraising to scale, the most important thing is knowing why and understanding why. Can we talk a little bit about that?
Yeah, it's the first question I just ask when companies are fundraising is, why are you fundraising? The obvious answer is, I just need money, hence I'm fundraising, and it makes a lot of sense, right? But then I ask, okay, but why do you need money? What's the money for?
And they give you the pie chart. 15% is going to go into tech, 20% into product.
Yeah, I've seen all the pie charts in the world. We've looked at so many deals over the past 15 years, and there's always a pie chart at the end. So
this is how we're going to use your money, Michael. Don't worry.
Yeah, it's like there's like the ask, and then you see the amount, and then there's a pie chart. And then there's percentage X to the team, and percentage Y to the product, and then Z to the new office or whatever you're going to do. But no one sticks to it, right? So we always have these pie charts, and no one sticks to it in the end. The essential question I always ask is, I want to understand what our capital does for your business on the mid and the long term. And if you're unable to answer that question, I'm not sure if you're ready to fundraise at this moment. So why is that important? So let's say you come to us, you're raising your pre-A, and you're doing a $5 million round, and we come in for $2 million. And I ask you, okay, you're going to get $2 million tomorrow in your bank account. What is the first thing you're going to do? The very, very first thing. I'm going to hire a team. So amazing, cool. Who are you going to hire? So who have you identified that you're going to hire in your team that's going to make an exponential difference within your company? And they say, oh, I'm not sure who yet. Okay, so do me a favor. Do a bit of homework and give me roughly the profiles that you want to hire in your team tomorrow. So they come back and say, okay, Mike, this is our new team composition. So okay, so these capabilities are already available within your current team. So is it your team not performing, or is that like another issue? The reason why it's important to understand how you're going to use the capital is we get our funding in, there's a big article in TechCrunch, and we all celebrate, and then we spend the money as fast as we can. And then after 12 months, we're like, oh man, you have to go back to market again, and we're going to go fundraising. What happens is those new investors are going to look at your past 12 months. And they look at the past 12 months in terms of performance and what you've done with the capital. So it's extremely important to understand why you're fundraising and how our capital is going to leverage your business. So what we typically like is no pie charts, please. It doesn't make a difference. By the way, if you have done a pie chart before, just do me one favor. Go back to that pie chart and see if you actually lived up to those percentages. If you stick to all those percentages exactly, I'm going to give you like a free pie or something, because it just never happens, right? But what I like is when founders talk to me about, okay, Michael, we're going into this new country, in this new geography. We have identified that we need to build a team. We need a GM. We'll need a different tech team. This is what a product's going to look like in this new market. It's going to be different than our existing products. We're going to remodel a bit of a product. So we need people to help us build this new product. We're thinking about above-the-line marketing for this part of our product line. And we're thinking about some organic marketing we're going to do right here. We're building this partnership with this corporation, and we're going to put some money into building a POC. To me, that's how you look at your financing round. Because then we can talk about, okay, the ROI on our investment is a new setup in a new geography that looks like this. Or an important feature into our product because our customers are asking. Or there's a customer demand that we can't handle. I need to add to my team. Or I'm running out of money. And that's a conversation to have as well. We oftentimes forget that running a business also means running out of money. And there's no shame in that. It's I don't know how to describe it, but it's very, very difficult to have a founder come to your doorstep. You can see in their demeanor, in their eyes, they're fully stressed out, and they're doing a fundraise. And they give me this entire fluffy story about, no, we're doing X, Y, and Z. No, you're running out of money, which is fine, because that happens in business. So let's talk about a bridge financing, and what does it look like? And where is your company after the bridge financing? And what can we do? Are we going to do a new round of equity fundraising? Do you need help? So it's a long-winded answer to your question. I want to understand why you're fundraising. And that helps us shape the round much better than just saying we're going out fundraising because of this pie chart.
I have so many follow-up questions. The first one being, obviously when we talk about scale, sometimes we get overwhelmed by it, and then we think about, oh, when you're scaling, you have to be at a certain level, and scale means true expansion, right? But scale happens at every stage of your startup, whether you're pre-seed and you're testing out, you're figuring out your product market fit, whether you're scaling your team to enable that people are coming in, whether you're scaling to actually a new market, right? And when you're at these different levels of stages, talk to me about the difference between the kind of VCs that you want to bring in, whether they're strategic or financial, and how, as a founder, would you advise them to pick who they should be getting at different stages?
There's definitely different forms of scaling. And before I get to your question, we had a company also in the fintech space. They had two products. We had a marketplace for financial comparison, and then we had an insurance product, which was kind of a brokerage product. And we went through like a long session with the founding team, because we sit on the board, and what we noticed was that we missed one specific product. So we kind of went through all the metrics of the company, and we couldn't understand why the company wasn't scaling any faster. So we talked to experts in the insurance space, to the different banks, to different partners, and we noticed that we missed one simple element in our business. So we said, we'll raise a bit of capital, and we're going to build out this specific product, which is going to exponentially grow our business. So sometimes scaling actually means looking at your entire product line, looking at your team, looking at your company, and a bit reinvent the products and the markets that you're going after. But as you are fundraising, there's definitely a few different types of investors. I was telling a story this morning that one of the founders that I had on a fundraising roadshow with me was last week. He said, to an extent, our company is doing really well. We know what we're doing. We actually have an amazing team in place, which he does, by the way. And some of the capital can be just financial. It doesn't have to be strategic. We know exactly what we're doing. We know.
Don't need you to nag me.
Yeah, just don't call me. You can wire the money right here. I'll make you very rich, hopefully. But just don't bug me. Yeah, those founders you have as well. But I think it's always helpful to have strategic capital on board as well. And those are investors that can actually help you through funding rounds by making introductions, looking at your cap table, which you could be cleaning up, sitting on your board and being an ally in difficult conversations with older investors, being a partner when you are fundraising or doing business development in different countries. So I think it's very important to have a mix of both strategic and pure financial investors on the cap table.
Yeah, fair enough. And we were also talking within that initial story that you were sharing how when founders come to you, like obviously being honest is the key, right? Being able to share whether it's the struggles or the wins, the challenges, the opportunities. And it's very much coming back to what you shared this morning about VCs making informed decisions, where the myth is always that it's very much, the relationship, it's very much the emotion, but there is an art and science to it. And as much as we say it starts off as an art and then it goes back to a science, at the end of the day, you are, returning back money and you have returns to, be good on. So it comes back to the science. Can you dive a little bit more into that?
Yeah, we've, and I can say this because I'm almost 50, so that makes it, I'm allowed to say this. I feel we over-romanticize VC and startup world sometimes, and sometimes too often. Building a company is extremely hard and difficult, and it's a lot of hard work. And running a business, like 90% is not fun. Maybe put it this way: it's rewarding, but it's not fun. There's a big difference between the two. So when we kind of talk about looking at companies at the early stage, and we're talking about scaling, I always want to talk about the difficult parts as well. And if you get us on board, we have the responsibility to return. So typically, a venture fund wants to return about 4x net, so net of fees to investors. So imagine you're running a $100 million fund. You have to pay back to your investors $400 million net. It's a lot of money. I don't have $400 million, so I'm not sure who has, but to me, that's a lot of money. So it also means that the moment we invest in a company, we need outsized returns. So we take that risk, and people understand the risk associated, but we need those outsized returns. That also means that for you as a founder, there's also a responsibility in taking on our capital and our expectations. So when you look at scaling a company, it effectively means that, so just kind of in terms of metrics and how we look at it, if we invest at a seed stage, so let's say we do give it on average, what's the seed on in the region? Maybe 10 million pre-money, thereabouts? Okay, let's say 10 million pre-money, easy. We put in a $2 million check into that round. That means that your business needs to get to at least $300 million in enterprise value for us to make any sense. So that's our starting point. We preferably like you to become a $500 million company, or even better, $2 billion company. That's even, then we have a party. Yes, the bigger the better. But that's the assumption we're working on. So it means that if you are building a company and you're saying, look, listen, I'm going to start with, I have an office in Abu Dhabi and I'm building a regional business. You have to build a fairly sizable business to get to those returns. So what we oftentimes do is at the very, very early stage, the art is really around getting to know the founder as much as we can, but all the rest is about science and understanding the size of the market, understanding how you are able to scale into that size as a founder, because that journey is not going to be easy. How are you around capital allocation? Like, fundraising is not easy as it is. Spending money is even more difficult. Spending it the right way to actually grow your business. We're talking about team formation. How are you thinking about building your team? We talk about your product strategy. What does that exactly look like? We're talking about partnerships that you want to build. So it's way more than just sort of giving you a check. We kind of really want to dive a bit deeper on how you're actually going to build this business and scale it to a certain size.
And your roadmap is super important in all of that. Just to wrap that up, the kind of VCs that you choose at every stage is just super important as well. I want to open the floor for questions, but before I do, maybe we wrap up what we're talking about in terms of, as a VC, we ended this morning on the kind of 6 main points that you're looking for when you're investing, especially when founders are scaling and they're moving their business and growing it. Can we talk a little bit about our 6 elements?
Yeah.
So there's,
Sure.
Go ahead.
Yeah. So basically, when we're all done investing, when we're all done with the due diligence.
Yes.
So our team has kind of written the investment memo, and it goes up to our investment committee, and we have a conversation in our team. We always want to sort of do like a final check between the partners, whether the investment makes sense, yes or no. Again, we have the good fortune, and I honestly feel that for us it's kind of a blessing in disguise. We've met so many founders over the past decade, but we do this final check to make sure that the founders we work with, we can work with them over a very long time. So I mentioned that company, and I'll get to the 6 points, but I mentioned that company CodaPay. Again, that's an investment from 2012. So that's 11 years. That's longer than certain marriages. So it's a very no, it's a very long journey, right? And we've been on board with them for a very long time. I still speak to Neil, Paul less, but I still speak to Neil on a regular basis. We've had, and I had another example this morning. So we invested in a company that was acquired in 2016. The acquisition was not amazing. It was a very, very rough acquisition. It was kind of a fire sale. One of the founders built a new company, and we invested again, just because the relationship remained for such a long time. And you know, I trust these founders with my kids. So it becomes this very, very trusted journey that you have together. So we make this final check before we actually invest, because we want to make sure that, and we get it wrong, of course, but we want to make sure that we can have this long-term relationship. So we want founders to be coachable and teachable. It doesn't mean that you have to listen to us, please no. But we want to have a discussion, and we want it to be an open forum as opposed to saying no all the time. I think there has to be sort of a passion about the business, and you live and breathe the company. You know, it's funny. There's a founder we have in our portfolio, and he's very successful in fundraising, in building the business. It's a massive business at the moment. Every time I see him, at every single, he could go to like a formal gala dinner, and he's wearing his company T-shirt, and it's like bright orange, and he wears it every single time. And he is so invested into this company that I just like this kind of course, he can wear a suit, but it's nice to see that he's invested into his company. I talk about invested. We always wanted the founder to be invested. Like, having ownership in your business is so important. We only invest in a company if you as a founder has ownership. Otherwise, it doesn't make any sense. You want to leave tomorrow. Of course, when you get to, you know, pre-IPO, of course you own a lot less, but at the early stage, you need significant ownership. So that's very important. We kind of talk about your ability to execute as well. Like, as a founder, you have like so many distractions. You know, you're invited to speak at conferences. You're being pulled into different directions. Your investors will tell you this. Your partners will tell you this. Your team will tell you this. You're hiring. You're moving into new countries. So the ability to execute and really kind of stay away from the noise. I mentioned this last week in a conversation. I'm not sure if you're kind of familiar with the term that you're able to see the noise. It's hard to explain, but it's like you're in this you're building a company, right? You're in this vacuum, and you're purely focused on building and getting things done and
like
getting.
You have tunnel vision.
Tunnel vision, and someone all of a sudden out of nowhere steps in front of you and tells something like completely random, and you still want to be focused, but you listen to this person, so you're distracted. Like, the founders that are able to kind of see the distraction and decide fairly quick if it's useful in their journey or not, and then say no right away. That's what I mean with seeing the noise. Once you master that, like, the best founders I've worked with are masters at seeing
They're
the
like
noise.
decisive.
Very, very decisive. Very, very decisive. Yeah. And I might have missed one.
You did miss one, but I forgot which one. I wrote it down earlier.
I've been talking so much today.
Ability to invested, experienced team builder.
Yes, team builder. So I think around building a team, it is really about being humble and letting go of your ego. Now, we have members in our team that are way smarter than I am, and I'm happy to work with them because it makes my life easier. But I know founders that have difficulty working with people that are equally as smart or better, or, at that part of the business. Again, I think as a founder, it's a blessing to have really smart people working for you. So being able to be a team builder is very important to us as well.
I'll wrap up what we were just talking about to say that scaling is an entire journey, and using every opportunity you have to build relationships with investors also leads to them knowing these 6 things about you it's not 6 things that are discovered in one meeting, and it's not 6 things that are discovered when you're pitching on stage. So every opportunity you have, whether you are raising or not, is an opportunity to build towards their checklist of you, because it's a relationship that you want to build at the end of the day.
Maybe as one example, I've been fundraising for the past 15 years or so, and I have investors. As an example, I have a big investor in Japan. I spoke with them for 3.5 years before they wrote their first check. And people are telling me like, Mike, you're crazy, you're going back again. At some point, I went to Korea 19 times in 1 year. And I had to, because it's all about relationship building. And it's so crucial to investing, especially in our asset class. If you're like a buyout fund, your real estate fund is different. In our asset class, it's all about building relationships.
All right. We've got about 10 minutes or so. I'll open the floor to questions. Does anybody have one? Yes, we've got 1 and then 2.
Hi, good afternoon. So you mentioned a while ago that most of the startups are 90% not getting funded. Yeah. Should I reverse the way? So what would I do is I would raise first money before I start this company.
Yeah, I mean it's a bit of a dilemma, right? So there are founders that say, you know what, I'm just going to do a round of family and friends, and that's going to be my kickoff for my fundraising, and I can validate the product, and then once I have a bit of traction, I'll go to VCs. It depends on the nature of your business and how much funding you need to actually get started. I'm a bit more conservative, I'm a bit more older, so I always encourage founders to start without funding, if possible. If your business model allows you to bootstrap your company in the first 6 to 12 months and build a little bit of traction, I think that goes a very, very long way. Now I'm going to contradict myself because there's a downside to that as well.
What kind of VC would you be if you didn't?
Exactly. There's a downside to that as well, because sometimes VCs like validation in terms of funding. So they want to see ability for you to be able to fundraise. So even if it is families or angels. So yeah, it's a bit of a catch-22, I guess. But if you were to ask me, I always like to see a bit of validation before you go out fundraising.
We have a question at the back.
I have a question about scaling a B2B SaaS in the Chinese market. So you see, like most of the content that's out there, it's scaled towards the English-speaking world, quote unquote USA. So it's like you put out a Twitter, get people on LinkedIn, and even regarding something like SaaS, you have these 3 clouds. You deploy. I've seen that you have these 3 options. You either deploy a SaaS on AWS, Google, Azure, and it's almost like the whole Chinese market is like it's out. Like you don't know what's happening in there, and they don't know what you are doing. And like, is it even a viable option for a early startup to scale there? Because now, there's one precedent of there's a game called Dota 2, which is like, so it's operated by Steam outside, but they licensed it to Perfect World to run in the Chinese market. So could you suggest something on those lines?
Yeah, it's a very good question. Don't get this often, but thanks for asking. The Chinese market in itself is, of course, extremely difficult for a number of reasons. There is actually a product, it's Ali Cloud, which is very similar to AWS. So they do allow for hosting on mainland China. What we've learned, we have backed a number of founders that are mainland Chinese, but they've moved to Southeast Asia. So we learn a lot from them and from some of our investors as well that are fairly big in the region. I think if you are a company outside of China and you're looking to scale in China, is find a local partner as soon as you can. That's actually crucial for any success in the market. Even the large scale businesses, the large MNCs, the large tech companies, they all have a partner locally. As either it's a joint venture or it's an investment from a local Chinese company into your business, which then helps you expand in the market. it's very difficult to go on it on its own for a number of reasons. There's a lot of capital in market that is chasing a few deals, so the competition is pretty fierce. The market itself is internally is very advanced. So for you to get a sense of who's going to be my competitor, it then helps to have like a local partner working together with you.
Any other questions? Oh yes, next to you, Joe.
Hi. What's your say on the idea of starting up your business online, and then once it gives back to you, reinvest in a physical place or rent a place or so on? Starting it online first if I'm unable, to do it physically. Yeah, thank you.
Yeah, we see that quite often. We have invested in a number of e-commerce companies that have started online fully and then eventually went to physical retail. Oftentimes it is pop-up, not permanent. So they use it as sort of an outlet to kind of market. And it's fairly common. We see that across the board. So yeah, it's definitely a good idea because online you can start with sort of less capital, and then once kind of the business has traction, you can do pop-up stores that are going to be physical. Yeah.
Amazing. Any other? Oh, one more.
Hello, Michael. Given the dynamic of the VC startup world today, probably globally, what are your thoughts on scaling with down rounds?
VCs don't like down rounds. Yeah, it's for me it's a reality. And one example, we did a session on down rounds during COVID. It was late 2020 with some of our law firms that we work with, and it is strange to me that down rounds is such a nasty word in our industry because it's fairly normal. There's this massive economic crisis, right? Globally, it's not like dedicated to like one. It's global. We've seen banks collapse in the U.S. That were heavy backers for startups. So down rounds are not weird. I think what is most important is to not hide a down round. I think that is very important. Just be very transparent about it to your investors. Even if your investors say, let's not do a down round, let's do a bridge round, and we call it a note, a note to the next equity round, so we don't have to write off or do a down round in the books. I really feel that transparency helps towards your investors. So if the market dictates that the multiple is instead of 15x, it is 10x on your top line or 5x, then that's what the market dictates. Then that's your new valuation, and you'll live with it. Because we all know there's going to be an upswing as well. The most important thing is that you run your business in a sustainable manner. And valuation is one part of it, but it's not the entire part. So I always, when we speak to founders, we say, yeah, okay, let's talk about your down round and let's see how we navigate this and how we communicate this as well to the other investors.
Do we have any more questions?
I am neither on the founder side nor on the VC side. So I am kind of that strategic person in the startups who try to work on focusing the founders on the roadmap. You can call me project manager, coordinator, anything. But my point is, so if a founder of a startup asked me and the team that we are trying to build a product, we don't have a client, but we want to go for seed funding. So and again, maybe he's working with startups and investors and talking to investors, but he's asking us to maybe send applications. So the pie chart from the application is already out. I heard that. So what stands out for such startups, which are working on creating a product, developing a product? They don't have clients yet. They do have a GTM, but still, nothing to show.
Yeah. So we have two recent investments where we invested based on the team and a product idea. No company, no traction whatsoever. And we're hoping they're going to build something, by the way. I think in the current market where we see a lot of companies that have become Me Too companies, there's a lot of interest from investors to look at new ideas. And even if it's off of a deck and the founding team, So how do you value? You of course value the founding team, and you have to have comfort behind what they've done in the past, or their skill set or their experience. And then the second thing is really around how much do we believe how big this market is going to be for this specific product. We see that it tends to be towards B2B companies, enterprise SaaS, deep tech, computer vision, climate, of course AI. We see a lot of those where there is no traction just yet. There's a product idea and an amazing team, but those tend to get backed fairly well.
Okay. We're just running out of time. Do we have any more questions? We can take one more.
What we can really draw on is probably around any flop cases. What went terribly wrong on the VC side as well as on the founders? And happy to hear your thoughts.
Yeah, I can talk about our learnings and some mistakes that we've made. I think the worst thing you can do is chasing a deal because someone else is in the deal as well. We've had a number of occasions, maybe one, where you kind of get a bit of sort of investment FOMO, and we've learned really fast from this, because what happens is you want to get in the deal regardless, and all your investment fundamentals go overboard. So things like ownership doesn't make any sense anymore. You kind of you ignore the red flags within the company. You just want to get into the deal, and you just want to get it over the line. And then when founders notice this, they're like, "Oh yeah, okay, let's put some more pressure on the VCs to put the money to work." I don't think those are good investment decisions. That's something we've learned. I think the other thing we've learned is go in deals too early, where it might be an amazing idea, but like the timing of the product to the market is just way off. We had this one company that's funny, and the founders became good friends, so I can also share this. So it's a company that was, they were digitizing legal contracts. So you had a phase in the US where everyone was like digitizing legal contracts, and you put them online, and then you pay a subscription to download those templates, and then you could fill them in yourselves, and they would displace lawyers altogether. I think we would have done ourselves a service to speak to a law firm and understand the dynamics in sort of the legal platforms and frameworks. So what happened was, this company did everything right, and they digitized all of these contracts. But we didn't understand, this is not a local play, this is a global play. Because I can sit anywhere in the world, I can Google term sheet, seed round, and I can get like 500 different examples. Half of them are free, by the way. So it doesn't make sense to put a subscription up for it. So we learned fairly quick that was a bit too early, but also the product market fit wasn't the right one.
On that note of learning, we will pause here. Thank you very much, Michael, for joining us today, and thank you everybody for being here this afternoon.